Think about the last time you felt uncomfortable about doing nothing with your investments. That's not because something has changed, it's because doing nothing feels irresponsible. Okay, but first I have to backtrack and clarify. When I talk about doing nothing, I'm not talking about never starting your investing journey. What I'm talking about is what happens after you have created the system, after you have started the machine. Only then it's true to say that doing nothing is often the right decision. But delaying the creation of the system entirely, that's not restraint. That's usually avoidance, where most people get tripped up. There's a clear difference between restraint and inertia. Restraint is about choosing not to intervene once the process is running. Inertia is never setting up the process at all. While they can feel very similar because both is essentially doing nothing, they lead to very different outcomes. And that's what you have to understand. As humans, we are wired to associate movement with control. That's in our DNA, and it has served us well for surviving as the dominant species. So action feels like responsibility. It feels like we're doing something. And sitting still, doing nothing, feels like neglect. It feels irresponsible. Markets tend to exploit that instinct. They create this constant feeling that we have to do something, this urgency, this desire to move. Here's the thing, markets don't punish doing nothing. It actually punishes frequent intervention. This wired association of our willingness to move and associating that with control, that's known as action bias. We all suffer from it. There's a really famous study by Michael Bar-Eli who analyzes professional goalkeepers during the penalty kickoff. What he found is that goalkeepers almost always dive left or right even when the data shows there's a statistical better chance by making a save when you stay in the center. So they dive because it looks and feels better to fail while trying than to stand still and watch the ball go past. Also, the crowd will probably hate you for that more. All of us suffer from that action bias. Like the goalkeeper who's diving pointlessly during the penalty, we feel like we must do something in order to justify our responsibility, even when standing still is the statistically significant choice. The drag that ends up happening isn't about bad ideas. It's really the accumulation of small and unnecessary actions. We see that in investing over and over again. Research from the UC Berkeley analyzed 66,000 investors and found something called the activity gap. Barber and Odion published a paper called Trading is Hazardous to Your Wealth, in which they analyzed these investors over 5 years. They found that the most active investors got a return of about 11.7%, while the market in that same period did 17.9%. The drag wasn't that they were making bad decisions or picking the wrong stocks, but it came from the transactions costs, the taxes, and the emotional exhaustion of constant decision making. So doing nothing when it comes to investing doesn't mean that you're disengaging. It means that you're making a decision in advance. In my own investing process, the hardest work often happens before, when I'm setting the boundaries for when I will take action. Strength is not about passivity, it's a pre-commitment. The thing about a pre-commitment, it's actually a really well-studied and known psychological tool. There's a concept called Ulysses contract, or more specifically, the pre-commitment strategy. It's based on the mythological story that Ulysses attached himself to the mast of his ships so that he wouldn't be lured by the sirens. One of my favorite authors and Nobel Prize winners, the behavioral economist Richard Thaler, used this exact principle to champion the Save Tomorrow program, which uses pre-commitment to help people with their investing. What he showed in that is that humans are much more likely to make rational decisions about their future self than their present self. So in the Ulysses contract, you're not being passive. You're actually tying yourself to the mast of your strategy so that when the market volatility sirens scream, you've already removed your ability to make a mistake. This becomes especially more important when you are delegating those strategies to somebody else. If signing your investment to a fund turns into a commentary where you're constantly pausing, restarting, intervening, overriding, then doing nothing has already failed. There's this famous phenomena called the behavioral gap, the Dalbar study, the quantitative analysis of investor behavior, which showed that investors in a fund perform significantly worse than the fund itself. This behavior gap shows that even when the strategy is successful, the people following often lose money, but only when they intervene. They pause, they resume, they override decisions of the very system that they chose to help them. If staying still feels irresponsible, that's usually the moment to slow down. You have every reason for that to feel irresponsible because in our careers, we have been conditioned that moving, taking action equals results. And we have been rewarded for that system. But investing is actually one of the few areas in your life where more effort doesn't always correlate to a better outcome. Because in investing, doing nothing is often the hardest choice, but it's also the correct one.